Welcome, curious minds, to another deep dive. Today we're embarking on a truly expansive journey through a collection of profound insights. You've sent us an incredible array of sources. I mean, everything from foundational investment theories and, well, high-stakes market crashes, to visionary leadership philosophies, cutting-edge marketing strategies, and even the very psychology of how we make decisions. It's like we're getting a privileged peek into the minds of some of the most influential thinkers across business and beyond.
That's right. And our mission today really is to sift through all this rich material. We want to uncover the most potent nuggets of knowledge. We're not just summarizing here. We're exploring how these seemingly, separate ideas are often deeply interconnected. We want to reveal patterns that can help us understand why some endeavors soar, others falter, and how human nature constantly shapes these outcomes. Get ready to connect some dots you might not have expected, and maybe see the world of business and innovation through a much wider lens.
All right, sounds fascinating. Let's unpack this incredible stack of sources and dive right into those unexpected connections that emerge when we bring them all together.
Understanding financial markets and managing risk. Okay, to begin, let's maybe try and demystify one of the most fundamental concepts in finance. It's often intimidating too, risk. We hear about it constantly, but in the investment world, what exactly is this elusive thing we call risk?
That's a crucial place to start, definitely. And what's fascinating here is how academics and practitioners have tried to formalize risk. Our sources introduce us to some really groundbreaking frameworks like modern portfolio theory and the capital asset pricing model, or CAPM. At their heart, these are mathematical models that fundamentally changed how people thought about putting investment portfolios together. Their basic logic, it's clearly outlined in sources like A Random Walk Down Wall Street, suggests you only genuinely get a premium, an extra reward for bearing risks that simply cannot be diversified away. Think of it this way. If you want a higher average long-run rate of return, you often have to increase your exposure to risks that are, kind of avoidable by their very nature.
And that's where a particular Greek letter, beta, enters the conversation, isn't it? It's a term you hear thrown around quite a bit in finance circles.
Precisely. Beta. It's a key metric within these models. It's basically a measure of a security's systematic risk. Now, this isn't about a specific company's hiccups, like a bad earnings report. It's the risk that arises from the general variability of stock prices and the tendency for virtually all stocks to move with the overall market, at least, to some extent. Imagine the tide coming in or going out. It lifts or lowers all boats. That's kind of like systematic risk. So a stock with a beta of 1 tends to move exactly with the market. A beta of 1.5 means it's more volatile, typically gaining more when the market rises and losing more when it falls. Conversely, a beta of, say, 7.5 suggests it's less volatile than the broader market.
Okay, so it's about its relationship to the whole market.
Exactly. And any remaining variability, what's left after you account for the market's general movement, is called unsystematic risk. This stems from company-specific factors. Maybe a strike at a factory, a new product launch that totally flops, a sudden regulatory change impacting just one industry, or even a scandal specific to one CEO. The theory suggests these unsystematic risks can be effectively smoothed out or even eliminated by diversifying your portfolio, spreading your investments across many different companies and industries.
Okay, so if I'm understanding this correctly, beta helps savvy investors adjust their portfolios.
Right.
By understanding which risks are unavoidable, the market's inherent ups and downs, and which can be managed, maybe diversified away through smart choices. But given how quickly markets can turn chaotic, like we saw in that 1962 crash mentioned in the sources, how much can investors really rely on beta in practice? Are there situations where these models, for all their mathematical sophistication, just completely break down?
That's a brilliant question. And it takes us right into the messy reality of markets, doesn't it? While the models provide a theoretical framework, history is just full of examples where market behavior deviates wildly from rational expectations. The 1962 stock crash, as recounted in our sources, is a really vivid illustration of how quickly things can unravel when sentiment shifts from optimism to, sheer panic. It wasn't just a slow decline, it was a sudden, precipitous drop. On Black Monday, May 28th, the Dow Jones Industrial Average plunged 5.7%, its second largest point decline at the time. The chaos was palpable. The New York Stock Exchange ticker tape. It was running an hour and 9 minutes late at closing. Think about that. Current prices were just obsolete. Brokers were working through the night just trying to straighten out the details of trades and accounts. They literally couldn't keep up with the volume and the volatility.
That sounds like absolute bedlam, just pure chaos. Beyond just falling prices, what triggered such intense, almost primal reactions?
While a crucial amplifying factor, something that turned a downturn into a cascade, was the deluge of margin calls. These are demands for additional collateral from customers who had borrowed money to buy stocks that had now plummeted, leaving them with insufficient equity to cover their loans. The fear, as described in the sources, was of a bottomless pit. It was reminiscent of the devastating 1929 crash, which was still a pretty raw memory for many people back then. This fear led to more forced sales by brokers trying to cover the loans, which further depressed prices, creating a vicious cycle of selling just begetting more selling. The exchange estimated a staggering 91,700 margin calls were sent just between May 25th and May 31st. Many of them woke investors in the pre-dawn hours, giving them their first chilling awareness of the crisis's spooky intensity. It really highlights that market mechanics, especially leverage, can amplify human emotion, turning a correction into a full-blown panic.
Wow. So the mechanics of leverage can turn a downturn into a devastating cascade. This connects directly to our sources discussing modern financial instruments and their inherent, sometimes hidden risks, doesn't it? Especially as we enter the 21st century.
Absolutely. We see how even sophisticated models like the Black-Scholes option pricing model, I mean, this is a Nobel Prize-winning framework, can systematically misprice financial options. The model, for all its genius, makes certain assumptions, like stock prices following a neat normal distribution or volatility remaining constant, assumptions that simply don't hold true in the real world, especially during extreme market events. It tended to underestimate the probability of extreme moves, those fat tail events, or it assumed the distant future would just resemble the present too closely. This inherent mispricing created colossal opportunities for those who looked beyond the conventional models and really questioned their underlying assumptions.
That's precisely what the Big Short excerpts highlight, isn't it? Jamie Mai and Charlie Ledley at Cornwall Capital, these young, relatively unknown investors. They initially found themselves shut out by the major Wall Street firms like Goldman Sachs, Lehman Brothers, JP Morgan. These firms apparently found their proposed sums risibly small for buying credit default swaps, essentially insurance against mortgage bond defaults. The established players were largely unwilling to sell these swaps, especially for the quantities these upstarts sought. They just dismissed their concerns.
Yeah, it perfectly illustrates the impenetrable fortress of established finance. These younger outsider investors, they had to somehow scale or dig underneath it. They encountered resistance even from Deutsche Bank when trying to buy platinum options as a hedging strategy. This resistance and the underlying complacency was partly due to the shockingly optimistic structure of subprime collateralized debt obligations, or CDOs. To put it simply, CDOs were bundles of thousands of mortgages, many of them subprime, that were then sliced into different risk tranches. The bottom BBB- tranche, supposedly the riskiest, could be wiped out by just 7% losses in the underlying pool of mortgages, yet they were still rated investment grade. And moreover, our sources reveal that Wall Street firms would even get rating agencies to accept different names for essentially the same subprime assets, making these pools appear diversified and safer than they actually were. It was financial engineering running wild.
It's almost as if some on the inside recognized the impending disaster and were scrambling to get out of the market before it collapsed, as one of our sources suggests. While publicly, you had analysts like one of Bear Stearns arguing that declines had nothing to do with the quality of the bonds and everything to do with market sentiment. Okay. Yet the traders at these very same firms weren't willing to sell at the prices their own analysts were publicly quoting. That's a stark contradiction, isn't it?
It absolutely is. And this discrepancy between public statements and internal actions, it raises critical questions about transparency and trust in financial markets. It shows how theory-induced blindness can impact even the experts. Once a theory is accepted, it becomes extraordinarily difficult, as the source says, to notice its flaws. As Thinking Fast and Slow explains, if an observation, like rising mortgage defaults, doesn't fit the accepted model, the model that says housing prices always go up, that these CDOs are safe and diversified, there's a powerful tendency to assume a perfectly good explanation is being missed. People trust the consensus of experts rather than challenging the theory itself. It becomes a kind of popularity contest in investing, where going with the crowd feels safer. But buying at the peak of popularity is often the most dangerous thing you can possibly do. The very belief in the efficiency of these models blinded many to the systemic risks they were actually helping to create.
Wow. Okay, so beyond these complex market mechanics and the psychology of crowds, our sources also delve into the very human element of finance, including the ethical dilemmas that arise when immense wealth and power are at stake.
Indeed. Den of Thieves provides a stark, almost unvarnished look at the world of junk bonds and insider trading back in the 1980s. You see the intense pressure, the lavish bonuses at Drexel, Burnham, Lambert, designed to keep top performers like Joseph Black and Peter Kissick loyal even as the firm faced investigations. And you see the catty animosities within Salomon Brothers' Office of the Chairman among powerful figures like Louis Ranieri, Tom Strauss, and Henry Kaufman. The environment fostered fierce internal competition and, at times, a blatant disregard for ethical boundaries in the pursuit of ever greater profits.
The story of Louis Ranieri and his mortgage bond department at Salomon is particularly fascinating. It illustrates both innovation and internal friction, right? Initially, he felt exiled to Siberia, seeing no significant chunk of money in the nascent mortgage market compared to the booming established utility bond market. He was literally given a broom closet to start. Yet his department eventually made more money than the rest of Wall Street combined, as he plausibly argued in 1984. Despite this incredible success, the firm later apparently made a mistake to have met Stone's demands for higher compensation for Ranieri's top performers, because they feared it would upset the established pecking order and the Treasury traders who thought the mortgage department was overrating its importance. It sounds like a real internal battle over recognition and the distribution of rewards for different kinds of innovation.
It profoundly highlights that tension, doesn't it, between rewarding groundbreaking performance and maintaining traditional corporate structures and power dynamics, and the inherent difficulty of valuing different contributions within an established hierarchy. We also see how Michael Milken, the architect of the junk bond market, provided an unexpected opportunity for corporate takeovers by identifying undervalued companies. Now, this wasn't his initial intent when he envisioned the market back in 1970 as a way for smaller companies to access capital. It fundamentally challenged the efficient market theory, which basically said all information was already priced into stocks, making such undervalued companies a rarity. Milken's innovations created a whole new landscape for capital accumulation, but, they also opened doors to aggressive takeovers and some serious ethical gray areas.
And the ethical questions are brought into sharp personal relief by the experience of Steve Wozniak, one of Apple's co-founders. He discovered Steve Jobs had kept bonus money from him for their work on Atari's breakout game. Jobs had told Wozniak they were paid $700, but in reality, Jobs received $5,000 and kept the difference. This deeply affected Wozniak, leading him to conclude, "Ethics always mattered to me, and I still don't understand why he would have gotten paid one thing and told me he'd gotten paid another. But, people are different." Unquote. Wozniak stated he would have given Jobs the money if he had simply been honest. That highlights a profound difference in character, a breach of trust that really lingered.
Yeah, these narratives really underscore that the intense pursuit of profit can indeed challenge personal integrity. And they expose the inherent inequalities and loopholes in tax law that Milton Friedman described so vividly in Capitalism and Freedom. He pointed out that actual tax rates, the effective rates paid by individuals and corporations, are often far lower than the nominal rates because of various provisions, deductions, exemptions. This leads to what he called a capricious and unequal incidence of the tax burden, where similar incomes end up being taxed vastly differently. This tax avoidance, while Friedman argued it was potentially essential for economic well-being by preserving incentives for work and investment, it comes at the cost of a great waste of resources, as people spend time finding loopholes and widespread inequity, which undermines the public's trust in the fairness of the system.
Taking an even broader, more philosophical view, the general theory of employment, interest, and money also explores fundamental ideas about capital and its role in society. Keynes provocatively states that interest today rewards no genuine sacrifice, any more than does the rent of land. That's a powerful statement.
It really is. And this concept is central to Keynes' vision of the euthanasia of the rentier. To unpack that a bit, a rentier is someone who lives off passive income, typically from investments, without actively contributing labor or entrepreneurial effort. Keynes is suggesting a future transition where capital, like land once it's all settled and owned, becomes so abundant that simply owning it no longer earns a significant societal bonus. He saw interest as a reward for the scarcity of capital rather than a genuine sacrifice of consumption. If we connect this to the bigger picture, it suggests a profound critique of how wealth is accumulated and distributed. It raises questions about whether societal goals like full employment and equitable prosperity can be met through market mechanisms alone, without some degree of state intervention to manage capital and direct investment. He envisioned a society where communal saving, facilitated by the state, could maintain capital growth to a point where it ceases to be scarce. advocating for a scheme of direct taxation to harness entrepreneurial skill on reasonable terms. It's a very different vision of a capitalist society than, say, Friedman's Tooth Act. Strategies for innovation and market creation.
Okay, let's shift gears now. Moving from the often turbulent world of finance to the realm of business strategy. Let's look at how companies strive not just to compete, but to create entirely new value and carve out their own uncontested spaces. Our sources delve into some truly innovative strategies to capture customer attention and build new markets.
Right, and this is where Blue Ocean strategy becomes a key framework. It's so much more than just a catchy phrase. It aims to make market creation systematic and actionable, not just, a stroke of luck. The core idea is value innovation. That's linking innovation directly to what buyers truly value, often by simultaneously pursuing differentiation and low cost, thereby breaking that traditional value cost trade-off. Starbucks, for example, they didn't invent coffee, obviously. Instead, they systematically shifted focus from commodity coffee sales, that crowded red ocean of competition, to the emotional atmosphere and the experience customers enjoy, creating a third place between work and home. They completely redefined what a coffee shop could be. Similarly, Pfizer, with Viagra, didn't just market a medical treatment for erectile dysfunction. They strategically moved their offering towards lifestyle enhancement, fundamentally redefining its market and attracting a much broader audience seeking quality of life, not just a cure.
So it's not always about some groundbreaking new technology, is it? It's more about redefining the offering and the customer experience, focusing on what genuinely appeals to buyers in a novel way. And this also involves what our sources call reconstructing market boundaries.
Exactly. It's about looking beyond the current competitive landscape to identify entirely new customer segments or new value propositions. And when you're trying to communicate this novel value, breakthrough advertising gives us some really practical, almost psychological ways to capture attention. For instance, it suggests surprising the reader by announcing that former limitations have been overcome, like that headline, "See what happens when you crush a Hartman DC-8, nothing," unquote. It grabs your attention because it defies expectation, right? Or it might dramatize the effort involved in creating something, like when Jen's finished designing this candle holder, we had to invent a whole new kind of candle. That creates intrigue and implies a level of quality and unique design. You can even address people who can't buy your product to create fascination, such as, if you've already taken your vacation, don't read this, it'll break your heart. This subtle reverse psychology piques curiosity from those who might still be considering a trip.
Huh. Yeah, it sounds like a creative gamble that, if it works, reaps 10 times the believability, because it engages the reader in a way that traditional, straightforward advertising often fails to do. It makes the customer feel like an insider, or like they're part of some special revelation. This leads us nicely into how companies build long-term relationships in this new marketing landscape.
Right. Our sources highlight permission marketing, which is a really powerful paradigm shift. Consumers actively volunteer to be marketed to rather than being interrupted by unwanted ads. This approach leads to far more relevant messages and significantly higher response rates because the consumer has already expressed an interest. Amazon.com, for example, starts with what might seem like slim permission, maybe just knowing a customer's purchase history. But they shrewdly move customers up the permission ladder by offering increasingly personalized services and discounts, like automatic review services for books purchased or special discount programs based on their evolving interests. This makes their communications anticipated and valued rather than ignored or seen as spam.
Yeah, it truly shifts the dynamic from interruption to invitation. It cultivates these learning relationships where companies not only elicit but also actively manage information about customers to serve them better, making them feel genuinely understood. That Walden Books example is great, offering a 10% discount to preferred readers who identify themselves by letting their purchases be tracked. This lets the bookseller notify a customer when, say, the next William Styron novel is out, or when an author they like will be in a local store for a signing. It transforms a purely transactional relationship into a personalized, value-added one.
Exactly. It's about creating an ecosystem where the customer feels valued, understood, and proactively served. That leads to deep loyalty and deeper engagement over time. But what happens when the very nature of the market itself gets disrupted? This is where The Innovator's Dilemma by Clayton Christensen offers really profound insights. It explains why even highly successful, well-managed companies can fail when faced with disruptive technologies. These technologies, they initially serve small, often unattractive markets. They're typically simpler, cheaper, or more convenient, but they perform worse than existing products on the metrics important to mainstream customers. They might, for example, only appeal to those early adopters, end quote. However, over time, these disruptive innovations improve rapidly and can eventually overshoot mainstream market needs in terms of performance, becoming powerful enough to displace the established players.
The example of the 1.8-inch disk drive is particularly telling here, isn't it? And it really speaks to this idea of a chasm between early adopters and the mainstream market. No major established company wanted to make them because the initial market was just considered too small. It wouldn't solve the growth and profit problems of a multi-billion-dollar company. Mainstream computer customers didn't need smaller, lower-performance drives yet. But a startup in Colorado did make them. The CEO of a large company might insist there's no market. But as the source says, among the employees, there was nothing about an $80 million low-end market that solved the growth and profit problems of a multi-billion-dollar company. And crucially, the salespeople, whose contacts and expertise were in the established computer industry, they weren't incentivized to sell small disk drives to entirely new, low-margin customers like automakers or niche portable device makers. They couldn't easily cross that chasm to a totally new customer base.
Yeah, that perfectly illustrates a critical funneling problem in large organizations. Their resource allocation processes, which are designed to maximize returns from existing customers. They inevitably direct resources to projects perceived to bring the greatest growth and profit from their current mainstream market. This often means missing those nascent disruptive opportunities that seem insignificant at first, but have immense future potential with totally new customer segments. It's a fundamental challenge that can lead to large, well-resourced firms failing despite having all the expertise in their industry. And this is where Purple Cow by Seth Godin offers a complementary perspective. It urges businesses to be remarkable, to think small initially, and appeal to just a sliver of your audience, rather than aiming for mass appeal right away. The idea is to create a product or service so outstanding, so worth talking about, that it becomes its own advertising, the purple cow, in a field of ordinary brown ones. It's about deliberately targeting those early adopters, those mavens and connectors we might talk about later. Those people who are open to new ideas and will help spread the word, eventually helping you bridge that chasm to the mainstream.
And some individuals truly push the boundaries of innovation to their extreme, creating entirely new industries or radically revolutionizing existing ones, almost single-handedly, it seems sometimes.
Elon Musk, for example, he founded SpaceX with this audacious, almost fantastical goal of conquering space and making humanity multiplanetary. Our sources describe how he approached this not just with vision, but with meticulous calculation. He created a detailed spreadsheet breaking down the costs to undercut existing launch companies, specifically catering to smaller satellites, which was a segment of the market not adequately served by the larger entrenched players like Boeing and Lockheed Martin. This wasn't just ambition, it was a calculated approach to identify a market inefficiency and exploit it with radical new methods, effectively creating a blue ocean in the space launch industry.
And his path wasn't without dramatic, really nail-biting challenges, right? The kind of gritty reality that often gets glossed over in the legend. There's that story of the Falcon 1 rocket body crumpling during air transport. As the military cargo plane descended into Hawaii, engineers heard strange noises and saw the rocket stage literally crumpling like an empty water bottle because of an oversight about cabin pressure. The team had to improvise with pocket knives to cut shrink wrap and wrenches to open nuts to prevent further damage. All within 30 minutes, racing against the clock before the pressure differential became too great. That story vividly shows the intense pressures and quick unconventional problem-solving needed in high-stakes innovation, and how Musk sent in a new team even before the damaged rocket reached its destination, determined to fix it immediately. Just relentless.
It powerfully highlights that innovation isn't just about the big idea, is it? It's the relentless, gritty execution, the willingness to adapt on the fly, and the resilience to face and overcome unexpected failures. Similarly, Jeff Bezos at Amazon had that visionary commitment to building the everything store, emphasizing unlimited selection as its very essence. He famously tackled the online bookstore market when, as the source says, no one had yet figured out how to do a good job selling books over the internet. He saw a massive, untapped opportunity in offering a selection that physical stores simply could not match, betting that customers would prioritize vast choice, even if it meant waiting for shipping.
And he, too, faced his own significant challenges and setbacks along the way. The A9.com general search engine, Amazon's attempt to diversify into search, famously failed. And the early e-reader prototype, the Kindle's ancestor, required a computer plug-in because wireless connectivity was crazily expensive at the time, adding like $400 to each unit, and data plans were insane. The display wasn't ideal either, and better technologies like e-ink were still unreliable and costly. These were not minor technical glitches. They were fundamental hurdles that could have sunk the entire endeavor.
Absolutely. These examples, from SpaceX's rocket to Amazon's early e-reader, remind us that even the most successful innovators face significant technical and market hurdles. They're often operating at the bleeding edge where failure is common, even expected sometimes. They reinforce the idea from Blue Ocean Strategy that the creation of blue oceans was not about technology innovation per se. Sometimes leading-edge technology was present, sure, but often it was not a defining feature. It was value innovation that linked to what buyers fundamentally value, and the reshaping of the market to deliver that value that mattered most. It wasn't necessarily about being first with a new tech, but about systematically redefining the market and the customer experience.
And Start with Why by Simon Sinek brings it all back to a foundational truth, doesn't it? That truly great companies, those that endure and inspire, are driven by a purpose, cause, or belief beyond just making money. Money is a result, maybe a byproduct of fulfilling that deeper why, not the why itself. It's about understanding why your company exists, why you get out of bed every morning, and crucially, why anyone should care. It's that clear sense of purpose that allows them to connect with those early adopters and ultimately maybe cross that chasm to the mainstream. 3. Leadership, teams, and organizational effectiveness. Okay, moving now from those external strategies of market creation to the internal dynamics of organizations. Let's explore what truly makes a leader effective and how that effectiveness cascades through teams and individuals within the company.
Peter Drucker's insights on this are absolutely crucial and honestly timeless. He emphasizes that effective executives get the right things done in the right ways. This isn't just about being busy, it's about being productive and purposeful. It involves asking what is right for the enterprise. The question that, if you don't ask it, doesn't guarantee the right decision, but, Drucker says, virtually guarantees the wrong one. It means stepping back and understanding the broader organizational goals. An effective executive also develops action plans with clear desired results, probable restraints, and defined check-in points, not just vague objectives. They then take responsibility for their decisions and communication, ensuring plans are understood, feedback is actively sought from colleagues and subordinates, and that everyone is aligned. And finally, crucially, effective executives focus on opportunities, not just problems. They see challenges as springboards for improvement and growth.
Right. So it's not just about what you do, but how you align it with the organization's core purpose and make sure it's clearly understood and actively pursued by everyone. Built to Last delves into this even deeper with the concept of core ideology, an enduring character that transcends product cycles, leadership changes, and fleeting fads. The HP way at Hewlett-Packard is a classic example they cite.
Indeed it is. The HP way, a code of ethics established by founders Bill Hewlett and David Packard. It included principles like deep respect for the individual, a commitment to affordable quality, and a focus on community contribution. This core ideology guided HP from its inception in 1938, serving as an unchanging self-identity even as leaders passed, product became obsolete, and markets shifted dramatically. The lesson from Built to Last is clear. It is far more important to know who you are than where you are going. For where you are going will certainly change. It provides a constant North Star in a constantly evolving business world.
That speaks so directly to the law of buy-in from the 21 irrefutable laws of leadership, doesn't it? Which states that your success is measured by your ability to actually take the people where they need to go. But you can do that only if the people first buy into you as a leader. Quote. It means that people don't primarily buy into a vision or a strategy. They buy into the leader first, their character, their integrity, their ability to inspire trust.
Exactly. It points to the necessity of having a compelling vision, sure, but one that's backed by consistent character and authenticity. People need to believe in the person guiding them. This is all about building profound trust, which Radical Candor highlights as absolutely essential for people to do the best work of their lives. When people feel free at work, when they are not treated like, cogs in a machine, but as respected individuals, they are far more likely to bring their full effort, creativity, and intellectual honesty to the task. Radical candor, that willingness to challenge directly while caring personally, is only really possible in an environment of high trust.
And leadership often happens within the intricate context of teams. So how can groups become more effective, especially in complex, fast-moving environments?
The discipline of teams offers crucial insights here. It argues that high-performing small groups demand both team discipline and single-leader discipline, recognizing that both are effective if applied in the right situations. A powerful advantage of teams is their capacity to use different talents and skill sets in multiple ways, often requiring flexible roles and shifting leadership to fit the specific task at hand, rather than adhering to rigid hierarchies. For instance, on a software development team, the lead might shift from the architect during design to the project manager during execution, and then maybe to a QA lead during testing.
But a common pitfall, and often a limiting one as the sources highlight, is the strong temptation to want to create clear, stable roles for each of the members, right from the outset. This can actually limit a team's potential to adapt, innovate, and leverage diverse skills effectively. It kind of turns a dynamic group into a collection of siloed individuals.
You've hit on a key point there. True team performance needs mutual accountability, an attitude that no one or two members of the team can be blamed if we fail because we are all in this together. This collective ownership prevents finger-pointing and cross-accusations when trouble strikes, and it fosters a deep, collective commitment essential for shared work products and the shifting leadership that complex projects often demand. Without this attitude, teams can easily get stuck, underperform, or frankly just dissolve under pressure.
This mutual accountability and focus on results reminds me of the discussion of delegation in some of the sources. Many leaders, particularly new ones maybe, default to what's called gopher delegation. Constantly directing every move, essentially telling people, go for this, go for that, and getting involved in every tiny detail. It must be exhausting for everyone involved.
It is, and it really stifles growth and initiative. In contrast, the 7 Habits of Highly Effective People advocates for stewardship delegation, which focuses intensely on results, not methods. It requires clear, upfront, mutual understanding of 5 key things: the desired results, the guidelines, and crucially, the fewest possible to avoid micromanaging, the available resources, the accountability standards, how success will be measured, and the consequences, both positive and negative. This approach, it takes more time initially to establish that clarity and trust, but ultimately it dramatically increases leverage for the leader and fosters greater initiative, problem-solving, and responsibility among team members. It's an investment that pays huge dividends in empowering people.
General Motors, for instance, learned these lessons about organizational structure and adaptable leadership the hard way, didn't they? In the crucible of rapid growth and crisis in the early 20th century, facing immense expansion and management issues, they famously developed a coordination by committee approach to manage their vast operations. Later, during World War II, they formed a War Emergency Committee, composed of 6 top executives to rapidly shift the entire company to war production. This committee temporarily ran GM, demonstrating how organizations can and must adapt their structures and leadership models to address unprecedented challenges, and how they need to delegate critical decision-making when the stakes are highest. Ultimately, though, organizational effectiveness, no matter how well-structured the teams or how visionary the leadership, it flows directly from individual effectiveness, right? How do our sources guide us in managing ourselves in this incredibly demanding world?
Managing Oneself by Peter Drucker is a powerful, concise guide here. It urges individuals to deeply understand their strengths, what they do well, and crucially, how they perform best. This means recognizing whether you thrive under stress or in predictable environments, whether you do better in big or small organizations, as a decision maker or an advisor. Few people work well in all kinds of environments, Drucker points out, and recognizing this is key to finding the right fit and maximizing your contribution. It also advises cultivating second careers or parallel careers for challenge and fulfillment, especially in the second half of life, often in nonprofit settings, to provide intellectual stimulation and purpose beyond their primary work. It's about proactive self-design for a long and productive life.
It's truly about deep self-awareness, isn't it? But also about a continuous cycle of self-improvement and principles. Life and Work by Ray Dalio stresses the importance of relying on the input of others and the whole body of evidence to see oneself objectively. Because, as he puts it, it is difficult to see oneself objectively. We all have blind spots. He implemented a powerful system at Bridgewater Associates called baseball cards, which recorded people's strengths, weaknesses, and believability on various topics, providing a constant, transparent feedback loop for everyone. Brutally honest sometimes, I gather.
Yeah, and that continuous feedback loop is crucial precisely because our own perceptions can be so biased and incomplete. We all have those blind spots. Another critical concept from our sources that profoundly impacts individual effectiveness is attention deficit trait, ADT. Now, this isn't a clinical diagnosis in the traditional sense, like ADD or ADHD, but a behavioral pattern affecting executives who are described as frenzied, distractible, and impatient. It's seen as a consequence of the overwhelming demands, constant interruptions, and information overload of modern executive life.
And this insidious condition marked by an inner frenzy, actively prevents managers from clarifying priorities, making smart decisions, and managing their time, turning otherwise talented performers into harried underachievers. This echoes the 4-hour workweek's advice on using the Pareto principle, the 80-20 rule, to focus relentlessly on the crucial 20% of tasks that will yield 80% of the results. It also advocates practicing elimination by going on an information diet, dramatically reducing interruptions like checking email constantly and social media notifications, to focus on what truly matters and regain control of one's attention.
It's about a conscious and disciplined effort to manage one's attention, not just one's time. That's a key distinction. As Peter Drucker notes, and this is a profound warning, if the pressures, rather than the executive, are allowed to make the decision, the important tasks will predictably be sacrificed. This means actively prioritizing, creating boundaries, meaty time blocking, and ensuring that important tasks, especially those converting decisions into action, are not overlooked or crowded out by constant, urgent, but often less important distractions. It's a constant battle against the tyranny of the urgent. 4. The psychology of human behavior and societal impact.
Okay, let's broaden out again. Human behavior. It's often the wild card in any system, isn't it? Whether it's financial markets or team dynamics. Our sources explore the often irrational, yet surprisingly predictable ways we make decisions and how that impacts everything around us.
Yeah. Predictably Irrational by Dan O'Reilly delves deeply into these cognitive biases. It's fascinating stuff. It explores concepts like the endowment effect, our powerful tendency to value things we own far more highly than identical things we don't own simply because they're ours. It also explores how social norms versus market norms fundamentally influence behavior. For instance, when market norms, like strict financial compensation, replace social norms, like mutual respect and community in the workplace, it can actually increase things like theft and fraud because the implicit social contract feels broken. It also points out how our expectations powerfully shape our experiences, affecting everything from how we perceive a product's effectiveness to how we react to situations. If you expect a wine to be expensive, you'll likely enjoy it more, even if it's the exact same wine as the cheaper bottle next to it.
And Nudge, by Richard Thaler and Cass Sunstein, shows how these insights from behavioral science can be practically applied to some of the world's biggest problems, like combating COVID-19, addressing climate change, or encouraging smoking cessation. It's about subtly influencing choices through choice architecture, rather than relying on mandates or heavy-handed regulations.
Exactly. This concept of choice architecture is incredibly powerful because it acknowledges that humans are, as the authors put it, humans, not purely rational econs. Our decisions are indeed predictably irrational, influenced by cognitive biases, heuristics, mental shortcuts, and the context in which choices are presented. By understanding these tendencies, policymakers and leaders can design environments, everything from default options in retirement plans to the placement of healthy food in cafeterias, that gently guide individuals toward better decisions without restricting their freedom of choice. It's about making the desired outcome the easiest path to take.
The power of habit also brings a compelling psychological dimension to decision-making, notably with the classic marshmallow test. This experiment, where young children were offered 1 marshmallow now or 2 if they could wait a few minutes, it revealed a profound insight. The children's ability to delay gratification correlated strongly with better grades, higher SAT scores, and more successful social lives years later. This powerfully suggests the deep importance of self-regulatory skills, the ability to control impulses, manage attention, and focus on long-term goals. It starts young.
Yeah, and beyond individual habits, the power of habit also explores social habits, behaviors that occur unthinkingly across dozens or hundreds or thousands of people. These are often hard to see as they emerge, but they contain an immense, often invisible power that can change the world, even ignite revolutions.
The Montgomery bus boycott is cited as a powerful, real-world example of this, isn't it? Demonstrating how individual acts of defiance, like Rosa Parks' courageous refusal to give up her seat, combined with these deeply embedded social patterns, like the routine of riding the bus for thousands, can ignite world-changing movements. It wasn't just Parks, it was the collective, often unthinking movement of many individuals whose daily habit was abruptly challenged and changed, creating this groundswell.
The Tipping Point by Malcolm Gladwell adds another layer to this. He discusses the smoking personality, a set of traits like defiance, impulsiveness, and sensation-seeking that made smokers seem cool to their peers, especially teenagers. It wasn't the cigarette itself that was cool, but the individual who smoked it, their attitude. This insight explains why many early anti-smoking campaigns often stumbled by focusing on the coolness of the cigarette rather than the allure of the personality type. It emphasizes the powerful role of connectors, people who link many others, and mavens, people with significant knowledge, in spreading ideas and behaviors, acting as critical nodes in social networks.
Yeah, that really speaks to the powerful, often subtle role of individual influence in social networks in spreading ideas and behaviors, whether it's a product, a trend, or a social movement. But outliers also reminds us of the critical failures that can occur in communication, especially under pressure. The Avianca Flight 052 crash is such a tragic example, where indirect language and deference to authority among the crew failed to convey the urgency of a critical fuel emergency. It led to the plane running out of fuel and crashing just miles from the airport. The flight engineers, "I guess so," and a sort of throat-cutting gesture instead of a direct, unambiguous statement of an emergency. It highlights how cultural norms and social dynamics can fatally impede clear communication when it matters most.
And if we connect this to the even bigger picture, our sources also touch upon grander historical and philosophical influences that have shaped human behavior and societal structures for centuries. Max Weber's seminal work, The Protestant Ethic and the Spirit of Capitalism, famously links Calvinism's inner-worldly asceticism, a rigorous, disciplined lifestyle focused on worldly work as a spiritual duty, and the search for proof of election, signs that one was among God's chosen, to the development of methodical work and the idea of the calling. The psychological inducements of this religious framework fostered a disciplined, systematic approach to work and accumulation, which Weber argued fundamentally contributed to the rise of modern capitalism in the West.
Wow, that suggests a deep psychological and religious underpinning to economic behavior, where deeply held beliefs shaped the very fabric of society and commerce, far beyond what purely rational economic models might suggest. And then The Road to Serfdom by F.A. Hayek offers a powerful warning against central economic planning that supplants competition. He advocates for a carefully thought-out legal framework that makes competition effective without the coercive or arbitrary intervention of authority. He argues that opposition to planning isn't a dogmatic, laissez-faire attitude, but a belief in competition is the most efficient and, crucially, the least coercive method of organizing human activity.
Yeah, and this raises that important ongoing question about the delicate balance between individual freedom and state control, particularly in economic matters. Hayek underscores that democracy is much more likely to be preserved under liberal political and economic institutions than under planning. As planning, even by well-intentioned socialist governments, he argued, can inadvertently lead to coercion and the suppression of individual liberties as the state takes on increasingly centralized power. It's a fundamental debate that continues to shape our societies today.
And then we have Machiavelli's The Prince, which, despite being written centuries ago, offers timeless, if often stark, insights into power and human nature. He reminds us that a leader needs the goodwill of the natives, public favor, and the affairs of this world are so changeable, it is almost impossible to keep an army a whole year in the field without being interfered with. End quote. Even in politics, context, perception, and maintaining public favor are everything. It's a testament to the enduring complexities of human nature and power, whether you're leading a nation or, well, launching a startup. Wow, what an incredible journey through such a rich and varied landscape of thought. Seriously. We've crisscrossed from the intricate dance of financial markets and the perils of theory-induced blindness to the soaring ambitions of space exploration and the subtle art of blue ocean strategy. We've touched on the internal workings of effective teams and the crucial importance of self-management, all the way to the invisible forces shaping human decisions and the grand philosophical debates that underpin our societies.
Indeed. We've seen that whether it's in investing, innovation, or leadership, understanding human nature, its rationality, and its predictable irrationality is absolutely paramount. The challenge, as always, is to extract profound knowledge from the past and apply it with foresight to the future, recognizing that even the most advanced systems and models are ultimately influenced by human choices, biases, and, a deep-seated need for connection and purpose.
So what does this all mean for you as you navigate your own complex world? It means that true understanding often comes from connecting these seemingly disparate dots. From recognizing that the financial analyst's beta, the marketer's purple cow, the innovator's struggle to cross that chasm between early adopters and the mainstream, and the leader's core ideology are all, in their own ways, attempts to understand and influence a world driven by both logical structures and powerful human psychology. That journey from early adopters to mainstream success, for example, it's not just a marketing problem, is it? It's a profound study in human psychology and organizational resilience.
Which raises an important question, I think. In a world of ever-increasing information, where the temptation is always to specialize and narrow our focus, is the greatest competitive advantage actually the ability to synthesize, to see the whole rather than just the parts, to understand the interplay between finance and psychology, between technology and human behavior, and to apply lessons learned in one domain to another. Perhaps the real deep dive is actually in connecting everything.
Something to ponder as you continue your own deep dives. We'll be back soon with more fascinating insights.